So welcome everyone. This is our fourth session of the options bootcamp, where we're going to talk about trade opening checklist, i.e. what are some of the steps that you should go through in your mind before you open an option trade. Strike price, expiration date, and the stock itself, these are okay, but there are many more important things that we need to go through it before we open an option trade. And that's a checklist that I want to share that with you today. But as always, please understand anything that we discuss here is not an investment, financial or tax advice. This is only for our learning purposes, only for our education. So treat it like that, just for education. For those who are new, who am I? I'm just a regular guy trying to earn my living through trading options and managing investment. Over 23 years of working in software industry, not 23 decades, not that old just yet. Most of the experience is in fintech and data management space. And I also own a small business on the side in Bay Area, investing for almost 15 years. My main focus is on the methodologies that don't need babysitting the portfolio. I wouldn't have been able to do it along with my job if those strategies need babysitting. Just not possible. As a retail investor, we can't always be glued to our screen. And that is why I don't even look at those trades which need me to do those, need me to attend to my trades. Philosophy, I always think about risk before rewards, and that has kept me sane, that has kept me in the game, I would say, through all peaks and valleys in the stock market. Seen the 2018 December, was trading options, also was trading options in 2020 March. It's okay. These things happen. Just that if you are always think about a risk, you keep your portfolio accordingly, will survive. Also active in crypto markets, and some of you who attend the Saturday session already know, and probably will do a separate session on the crypto. And I host a Saturday discussion with like-minded retail investors. Been doing it for almost a year now. Outside of this session, you can connect with me through various other channels, most all the social media. Plus, we also have our Slack group. So for those who are new, I'll just share this links to all of these in the chat. Feel free if you want to connect with me or want to be part of the chat group, because we do talk about some trades. Sometimes we just also talk about some fun stuff. Also look at what's happening in the markets. My main focus is to become a good investor. Even for an option trader, we need to have a market awareness. So we chat about a lot of things. Let's do a quick overview of what are we going to cover in this boot camp. Congratulations. Now, today's session is the last session at a beginner level. But our boot camp, we're going to talk about everything, right from a beginner level all the way to an advanced level. You know, some companies charge a couple of $1,000, or maybe something more, sometimes more, just to give you a theory of all that we're going to discuss. My charge is that please be active. Please go ahead and do the stuff that we talk about here. That's my only charge. And if you do that and you can start on your journey, that'll be the best thing for me. So you can attend it. Make sure you go back and implement it. So today we're going to talk about our session number 4. We're going to look at a checklist to follow for opening option trade. Then we will jump into an intermediate level where we're going to talk about small account option strategies. I'll take an example of a small account, 50K, and create an options portfolio. Then we look at how to manage some of the trades, look at trade exit checklist, and finally we move on to advanced level, where now we start to look at not just a trade, but overall position level stuff. Then if we move from position to overall portfolio level, right? How the various changes in options, how the options are impacted by various changes in the stock related parameters. What are those Greeks, deltas and theta, vega, gamma? You know, these do matter. Once you start becoming more and more active, once you start going deeper into options, once you start looking at options as a means for survival, for as a mean for putting food on the table, when it is no longer an itch to scratch because casinos are closed. Now, if once it becomes a mean to earn your livelihood, you will need to understand these things. So we'll talk about all of those things in the advanced level, including how to reduce risk, how to hedge your portfolio, and finally, a bonus session. For today's session, a quick housekeeping. This is an important session, so please, if you are having Facebook, Instagram, Netflix, or any other social media channel running on the side, I request you just close it down. We're gonna be here for maybe two hours, so I know we all can survive without social media for 2 hours. So focus on today's session for now. You can ask your kids or spouse or partner to stay out and not disturb you. Pets can stay in as long as none of them jump onto your keyboard and disconnect you. So I like pets. I'm not against them. I love them. So you can keep your pets in. No problem. During the session, ask questions, participate in the discussion. We want to make it, if it is more back and forth, it's always a lot of fruitful discussions come through it. And after the session, you can send an email if you still have a questions, or you can ask the questions in the chat group in the Bootcamp channel. I have shared the link to join the chat group in Zoom chat. So I use Slack and created a special channel, Bootcamp. If you have a question, ask here. Again, the idea is please go ahead and start doing these things. And if you are getting stuck because you're not sure if this is the right trade, or maybe you want to review it with someone, yeah, pop your questions in the chat. And at least I'll give you feedback. Now, then you can decide what you want to do with it. If you have missed any of these previous sessions, you can always go to the website, register, and you can view the recording of all these sessions under menu Members Bootcamp. You'll see it right here. Number 3 is already up. Generally by Thursday, the recording will be uploaded, and I'll send a notification through the meetup. So if you want to go back and review these sessions, and it is important that you understand the concept that we have already discussed in these sessions, because we're going to build on top of these sessions. By this time, you have all should have realized we started with the very basics of cash secured put, started moving into covered calls, then starting moving into the next one, which is moneyness, and now we are getting into the checklist. We continue to build up on the knowledge that we have gathered. So if you have not gone through, or if you're missing some of those concepts, going through the video is a good way to refresh those concepts. Okay. Let's look at some of the trades that I had shared in the bootcamp as a paper trades, so that you can get a practice of your own in your simulator environment. Again, the whole idea is that while you are in this boot camp, I want to show you basically practice what you preach, right? We talked about cash secured put, and in the boot camp channel, I mentioned a couple of trades on the cash secured put, and we'll see. I don't know how those trades would behave. I have no visibility into future. I don't have a crystal ball, but the idea is we'll put on the trade, and we'll talk about it in this meeting. How it went. It will go against us. Fine. How do we manage it? So want to make it a little more interactive, make it a little more practical, that we actually see those trades and how those behave. So let's look into some of the trades that for a paper trading for practice purposes we talked about. The first one was a short put. It was a bullish trade, selling a put on Bank of America, 21st May expiration, strike price 38, premium of 95 cents. So we closed it at profit. Second one was short put on Roblox. Again, this is because, hey, I'm okay to take possession of Roblox. I just want to give myself little room for error. So stock was at 73. We were bullish on this, wanted to acquire it at 70. Instead of putting a limit order to buy the stock, went ahead and did the short put and collected a premium of $5.70. This, I'm still holding this. So let's see how this trade looks like. Again, I'm using Think or Swim as a trading environment. Let's look at this, our paper trade account. Let's look at where Roblox, how is it looking? Still better. I mean, still, even though from 73, it has fallen down $3. We were bullish on it, but still it is above our break-even point. So I'll continue to hold it. By this time, generally it would become profitable, but because Roblox is having earnings coming up in Roblox is having earnings in a few days. That is why it is still not moved into profitable zone. But it is still way, I mean, we still have a $4 of margin for this to stay in profitable zone. Okay. The next one is the covered call. Again, this was based on what we learned in session number 2. If you hold a stock of a PagerDuty, go ahead and sell a covered call, far away covered call. We don't want to let this, I am bullish on the stock, but why not earn some dividend? Why not earn some yield while I'm holding the stock? PagerDuty is a growth company. It doesn't give dividend. So how do I make use of the stock which is lying in my portfolio? Sell far out of money covered call to earn some dividend. That's exactly what we did. PagerDuty fell down today, close that one for profit, and whatever profit we made in the option trade, that helps us to reduce the cost basis of the shares. So we still have all the shares. We just made some little money on an option trade, which means the cost of holding those shares has now come down. Right? And because I still hold the shares, I suggested today mention the same thing on the channel. We can go ahead and do another covered call. Again, rinse and repeat. Stock was at 40, 39. Did give ourselves $10 room. So stock has to climb 33% to reach 250, which would be okay. I hold the shares, so it will be beneficial for me. If not, we reduce the cost basis by 2% in next 45 days. We can generate our own dividend income of 2% in 45 days, even if the stock stays where it is or even if it falls down. So this is one more sample trade. We'll see how it goes. Could go up, could go down. We don't know. After earnings, what happens to stock? Nobody knows. So we'll see how it moves forward. Anyone tried any of these paper trades? I would suggest you try it. It's in a simulated environment, so there's no risk anyway. The whole idea is it will show you how you get into the trade, how to manage it, how to how you feel emotionally when the stocks goes up and down. So that's the whole purpose. Okay. All right. Any questions thus far on the sessions that we've already covered on short put or cash secured put and covered call? Nope. Okay. Let me ask a question then. All right. There should be a poll in front of you to let me know what type of option trades have you done so far. Maybe after attending this webinar or the boot camp, or maybe you are already doing option trades. Just want to understand where you are on your option trade journey. Okay, anyone who have not done any option trades yet, you can put it in the chat. Okay, meanwhile, let me address a question. If short put comes close to the strike price, do you sell to open the short put and open a new one at a different strike price? So Liz, I hope you meant to say, do you buy back the short put? Because I already sold to open the trade. So to close it, I have to buy it back and then open a new one at a different price. So it depends on what's my objective was. So if my objective was to acquire the share and I was doing it only to acquire it at a little lower cost basis, or to reduce my cost of acquisition, and I don't mind owning the shares, maybe because it gives dividend, then I will just let it be assigned to me. If my purpose was to acquire the shares and hold it, in that case, I will just let the share assign. I got the shares. So in that case, I was doing short put just as a replacement of a stock buy limit order. I just wanted to get paid while I'll wait for the stock to hit my limit price. In that case, I will just buy the stock, and then whatever I wanted to do, why I wanted it, the stock, and what I wanted to do it, I'll do that. But if my only intent was to just profit from an option trade and the stock has gone down, it is near my short put, we'll manage it. And we'll talk about how to manage those trades, because now I don't want to own the shares. My thesis when I did the trade was not to own the shares. I just want to capture the premium. In that case, I'll probably will roll it out, or we'll do other trade management techniques that we will talk about in subsequent sessions. Okay. All right. I see one response not done any option. So in that case, I would suggest do some paper trades, get some practice, because all the concepts that I'm going to talk about in this boot camp, we are already near the end of a beginner session. Now, going forward, we're going to start talking about how to manage the trades if those trades are going against you without taking on additional risk. So if you have some practice, if you already have some live trades, you can use it in your own portfolio. Otherwise, you can attend this boot camp, go back. If you're not done anything, 2 months later, you'll still be wondering, what was a call? What was a put? We forgot about it. How to go back and restart it again. And I mean, I have done it in a different context. I have gone to skiing boot camps 4 times. And every time I go and attend a beginner session. Because I go it like after a gap of 3 years, 2 years. So every time I go it, I'll take a beginner session, do it for a day, practice the next day, come back, no ski for next 2 years, go back again, and I'll just have to repeat the beginner session because I don't know. I mean, I forgot everything. I have 0 practice. So it is important that you get some practice, have some trades to work on. And that's what I suggest. If your trading platform provides you with the paper trading, go ahead and do it. Or if you have a lot, already have options enabled in your brokerage account, go ahead and do some of these trades. I mean, if you're active, you might be willing to buy or sell shares, maybe use options instead. Let's jump into today's session, which is checklist for opening option trades. And this is a checklist that I go through. When I started my journey of option trades, I actually had this checklist on a post-it paper stuck onto my laptop. You know, on the laptop, where you have your mouse on the sides, you'll always have a space. So I had this, put it onto my post-it and stuck it over there. Because I was new, and every time I can go back to my notes and see, okay, what's the checklist to go through it. Slowly, steadily, it becomes a habit. It becomes a muscle memory. But maybe once you're starting off on your option trade journey, maybe it will be useful to maybe put a post-it on your table, on your laptop, or on your computer, so that before you open an option trade, just go through the checklist and is everything okay? Yeah, good. Send the order. Okay. So before we go in the checklist, why am I talking about checklists for opening a trade? What's the importance in options, specifically when you're trying to open a trade? Okay. In the stock world, if I want to buy the stock at my limit price, I'm not getting it. Maybe I'll move the price a little bit up or down, a few pennies up or down. And if it gets hit, it gets hit. There's nothing more on the stock side. And of course, you have to also, some of these things will also apply to the stock. But there are some things which apply only to options. Or maybe while I'm going through this, I'll talk about it. So that even if you're not doing options, this will still be beneficial if you're trying to build your portfolio only with stocks. Okay. But for options, why I want to focus on checklist for opening the trades. Why the opening trade is important? It is because as an option seller, and this probably may not apply to option buyer, but as an option seller, which I am, which I believe is the only way to make consistent income and be successful in option trading. Option buying works once in a while, not always. If you want to be in options as a business, if you want to be trading options for next 20, 30, 40 years, you want to be in using a strategies that will work in a longer term. And mostly option selling works. Of course, it comes with a risk, and that is why we also talk about how to manage that risk. And as an option seller, the most important step is trade opening. We looked at the case for, let's say, short put. Roblox, I got $5.40 as a premium. If I don't want to own Roblox, if my only intent is to just capture option premium, the maximum money that I can make in that trade is $5.40. So the maximum amount of money, maximum amount of profit is determined at the trade initiation, at the trade opening. Let's go back to Roblox. This was Roblox. And if I look at this P&L diagram, if Roblox goes to 90, what's the maximum money I can make? Oh, instead of 540, it is actually 570. 570. It goes to 100 before 21st May. I can, by 21st May, I will make only $570, not more than that. So when I open this trade, I put a lid on the maximum amount of a profit that I can make. So that is why it is important that when I open the trade, I open it at with the best position or at the best time. After that, if Roblox goes against me, we have to manage it. So how you open a trade, when you open a trade, that can make a huge difference in the profitability of the trade. So what if I was able to collect only $3 of premium? In that case, my break-even point will be 67. So if Roblox falls down to 67, ooh, I'm at a break-even. Now, if it goes further down, I'm losing money. But because I'm able to collect $5.70, I have way more buffer. So that is why trade opening is very important for option sellers. And that is why we want to focus on a checklist for opening the trade. But why checklist? Why not go ahead and open the trade? I mean, what's the point in going through checklist? So that we can be consistent. And as you advance further, you'll see, I don't like to play big shots. Go back when I talked about my introduction, I'm like, I think about risk before rewards. Going too big could be an easy recipe for blowing up your portfolio. What I believe in, stay small, but be consistent. It's like you're trying to build muscles or you're trying to lose weight. You have to be consistent. Do it every day consistently. Not that you on one particular day, I ran 5 miles and then I'm not done anything for the next 2 weeks. And then suddenly I get up and then again run 6 miles and then not do anything. The better way is to go ahead and do it a mile or 2 miles, but do it every day consistently. So checklist will help you to be consistent and take the emotions out from a trade. More and more I stay active in market, I've realized that emotions play a way more important role than the credit or the news or the eyeballs that it received from financial media. Everyone will talk about and look at this indicator, look at this setup, look at this, how the channel is going, look at where the stock is in terms of Bollinger Bands, or look at where the MACD is, look at where RSI is. All that is okay. But as you start doing more and more, you will realize that emotions play a lot more role in the profitability of your portfolio, whether it is stock or options, doesn't matter. And if you have a checklist, if you have your own system, it will help you in taking emotions out of it. So number 1 in the checklist, and this is in priority order. Some cases maybe you may be able to move something up or down, but largely this is in the priority order. So the top priority before you open any trade, and this applies to both stock as well as option, I religiously follow this, is your position size. What I mean by position size is how big exposure, how big risk do you already have on this particular ticker? So let's talk about Facebook. You know that a lot of folks have been online, have not been able to go out, and a lot of folks are very active on social media or using gaming or searching for something. And you want to let's say, do a trade on Facebook or Apple for that matter. But before you do any trade on it, check how much exposure do you already have on Facebook. And I will focus more on from an option side, but it also applies from a stock perspective. Do you already have too much of a risk on Facebook? At the end of the day, no one knows where the stock will go in short term. You might have all your indicators lined up, stock could still go against it, against your indicators. My thumb rule is don't let in the risk on any ticker be more than 5 to 10% of your overall portfolio. Why retail investors stay away from stock market is the experience is that you blow up your account. And I've been advised and I've been warned by my well-wishers to not go into stock market as a retail investor, but just go ahead and buy mutual fund because, hey, we don't understand. You'll blow up your account. And I've seen people blowing up their accounts because they've gone too big on the position size, because they had a huge conviction that this is the right thing to do and let's bet the house on it. And it didn't go in their favor. So this is the golden rule that anyone who wants to be active in the market, whether stock or options, and want to do it for years, keep an eye on what's your overall risk. Don't let it be more than 5 to 10% of your portfolio. Okay. Don't ever violate this. Because if you're right on this rule, if you're right on this criteria, and if you go wrong on everything else that we're going to talk about in the remaining session, you will still survive. You won't blow up your account. You will still be active in the market. Even if March 23rd like scenario comes in where the stock market was down from top, it was down 35%, still okay. You will still survive. But if you go wrong on this one, then nothing else would matter. We're going to talk about how to pick an option strategy. We're going to talk about which expiration period we should pick up. Those are all secondary. That is why in the beginning I was saying, when someone asked me, can you tell me which strike price in the expiration period you picked up? I have to politely say, no, I can't share that with you, because those are the secondary things. Those are not even a priority list, because you pick up that, but you've gone wrong in position sizing. I'll still survive. And then you will be worried because you violated this rule. So first is to focus on position size. Okay. All the headlines that you see, I always try to go deeper into the headlines. You will hear it on the financial media. You'll read it on the newspapers and the magazines about how risky these option trades are. I'll take a couple of examples. I've talked about those examples in Saturday meeting also. I'll share that again with you. Just try to double click on it and understand what's the reason. The reason which I feel, which I see, which I find the most prevalent reason is too big a position size. If they've not gone that big, markets always go against you. You don't control markets. But what we can control is the position size. And all those horror stories are because those investors have violated the position size rule. And this is something which I can't understand. I mean, those are hedge fund managers from the top B schools of the country, have been in this business for way longer, just that their emotions, their greed got better of them, violated the position size rule. Now coming to the option side, why? There's a math behind it. So I want to share this math. I think in a previous bootcamp, I actually didn't share this, but I thought it will, when you look at these numbers, and when I looked at it, then it clicked on, wow, it does make sense. So why not? So that is why this is the golden rule for me. Remember, I told you, keep your risk not more than, in one taker, not more than 5 to 10%. So if you have 5%, it means you can actually have 20 trades, each with 5%. If you keep the risk at 10% of your portfolio size, then you can have those 10 consecutive trades. Okay. Now, on the left side, this is a probability. If my probability of a profit on a particular trade is 50%, and then I'm doing only one trade, it means I'll either win or I'll lose, 50-50 chance. It means I'm gonna lose 1 out of 2 trades. That's what the probability means. Basic high school probability. We don't need anything more than the high school math to be successful in options. Only thing that I had to go back and refresh was a standard deviation graph, or was a normal a graph, the bell curve graph, and refresh the concepts of standard deviation. Because I read it in high school, forgot, like 35 years. Nothing beyond that, no college calculus needed. Basic probability, 50% chance of success means 1 out of 2 trades will be profitable. But if you do 2 consecutively, one after another, what's the chance that you will lose both the trades? It's 25%. 5 trades, what's the chance that you would lose each of those 5 trades that you've done? If the probability of winning is 50% in each trade, it is 1 in 32 chance. 10, 1 in 1024. 20, 1 in a million. So if you're keeping your risk at maximum risk in one taker or one trade at 5%, and when you're doing a trade, you have 50% probability of profit, and you do that 20 times, because each one is just 5%, the probability of blowing your account is very less. 1 in a million. But these scenarios do come. How about do a 60%? You see, the probability that you will lose all the 20 trades consecutively is 1 in 90 million. Now, as you advance, as you move forward, we'll talk about it. What's my sweet spot for doing a trade, option trade? I start with around 70% probability of profit. This is what gives me optimal risk reward ratio. Stock is 50-50. You bought a stock can either go up, stock can go down. And if you look at your P&L diagram, if you buy a stock, it's a 50-50 chance. In an option, we can define what's my probability of profit I want to. Well, let's go back to Roblox. So if I just look at the probability of profit on Roblox, right now it is 63% profit. Because anything above here is a profitable zone. Anything below here, I'm losing money. 63% probability of profit. I generally would want to do 70%. And if I do 70% and I keep my risk in individual trade to be just 5% so that I can do 20 trades minimum, the probability of me blowing my full account is 1 in 28 billion chances. Even if you take up a risk and do 10%, you still have a way higher chance. And these things will happen. 1 in 170,000. So people say that March 23rd was 1 in 10 million chance. Whatever happened on March 23rd, we're still okay. We're still in the game. So when I looked at these numbers, it started to make sense. Math, it's not a figment of imagination. There's a hard math behind it. To lose all the trades that you have done, each with a probability of profit of 70%. If you've done only one trade because gone too big, you bet your house on it, it will be 30% chance that you'll blow it off. And the 30% can occur anytime, 1 in 3 trades. But if you kept your position size lower, you kept it at not more than 5%, means 20 trades. To blow up your account, you have to lose all those 20 trades consecutively. Very low probability. So that's why focus on position sizing. Because if we don't, doesn't matter how big the IQ is, how high the IQ is, or which business school have you been to, or for how many years have you been in hedge fund or been selling options. You just blow up your account. James Cordier. This gentleman's story was very popular among option trading folks, especially option sellers in 2000. I think it was 2018, if I'm not mistaken. He used to run a hedge fund. He used to manage money for his clients. He, in fact, wrote a book on option selling. He knew everything about option selling. What did he goofed up? Became too big in his position size. Lost $150 million in 3 days, and the hedge fund was closed. He had to wrap up his hedge fund. Why? He took 2 big naked call positions in natural gas. I'm not getting the details into this, or what does naked call do. So when the natural gas, he had future positions in natural gas, short positions. When it suddenly went up a particular day, our margin call had to wind up the whole account. His strategy was right because natural gas came down. If his position size was not as big as what he had, his strategy was right that the natural gas was too overvalued. He wanted to short it. So natural gas actually fell down later on. But because his position size was so big that a flare up which happened for a few days in natural gas, before his strategy actually could play out, he got such a huge margin call, he couldn't honor that, and his account was completely closed off. He actually came onto YouTube to apologize to his investors. So in this case, Great strategy. His options were not, they were still far away from the expiration period. Nothing wrong in the strategy. If he was able to hold his option positions till expiration, he would have made money. Issue was position size, not a strategy. More recent one, 2021. And this happened in the stock world also. Archegos rose up. It also impacted the stock market. What he had? It came from a very respectable, the pedigree is very respectable hedge fund, worked in a Tiger management, a Tiger global fund. They're part of what they call as a cub. The issue with Archegos was two big positions in very few tickers, Viacom, Discovery, and a bunch of Chinese stocks. Viacom was $10 in 2020, went all the way to 95, 96. Too much leverage, too bigger positions. One day Viacom fell down. Margin call was initiated by many of those brokerage firms, many of these institutional firms through which he held a positions. Credit Suisse, Goldman Sachs, JP Morgan, Morgan Stanley. They had to liquidate all his holdings. Credit Suisse is still counting the total number of losses. I think the last number I heard was around $4 billion. Again, anything wrong with the strategy? I wouldn't say it. What was wrong? Too big a position size. And it, in some cases, took 20x leverage because it went too big. If it was not that big, Viacom had fallen down, still okay, would have survived. So whether it is stock or it is option, most important lesson for us is the position size. And if you still think that doesn't make sense, or the position size, you don't think that this is the most important criteria, I would say you can drop off and no need to look at the rest. These are very smart people. Those who manage millions of dollars, in some cases, billions of dollars, especially Archegos was like billions of dollars, have had very successful careers throughout their life. What killed them was getting too big. It could be greed, it could be whatever. I don't care why, what's the reason, but they got too big. Same with the James Cordier. He's an author of a book on option selling, got too big. So next time when you see or read somewhere talking about how risky the option selling is or option trading is, try to double click it. Send it across my way. We'll do a deep dive analysis. We'll figure out, end of the day, most of the time I go back and look at it, it's like position size is too big. Strategy is wrong, fine. You won't blow up your account. The only reason you'll blow up the account is because the position size is too big. All right, let's look at the next one. Any questions on position sizing? And you can define, I look at the criteria of between 5 to 10%. Does that mean I've never violated it? No, I'll be honest. In some cases, I've figured out that one particular ticker has become 20% of my portfolio. And then I know this is a very risky position for me. I like watch it very closely and trim it before any risk happens on it. So this is the most important concept to understand, especially when you're selling options, which is the right way to be successful and survive in options business. So any questions on position sizing? Or I see a question, even if you have good probability of profit, you could also be risking a lot. So if you have a good probability of profit, doesn't mean that it's a guarantee. That is why even with a higher probability of profit, we still have to understand and keep the risk in check. Say I do a trade on Amazon. Let's say I have a $50,000 account and say I sell a trade on Amazon. Too big for my position size, but just for fun's sake, let's do it. It in June, EMZN. You know what? I come back and sell far out of money put here. Say 2,400. What's it? Okay, 97% probability of profit. Let's close this. This one has got 97%. Let's see based on today how the stock varies, almost 100%. I'll make $370 with almost no risk because Amazon is at 33.11. The probability of it hitting 2,400 based on what the market participants are looking at is close to 0%. So this is called probability of out of money. Or let me switch it. I'll switch it to probability of in the money. 3%. There's a 3% chance, looking at the market dynamics today, that Amazon could go down to 2,400. So I may be tempted to say, let's sell some put here. You know, let's say at $4, if I take a mid price, let's say $415, $415. 97% chance that I'll be successful in this. I go ahead and sell it. Say something happened to, God forbid, nothing happens here. Andy Jassy, something happens to him. He's a new CEO. Or Amazon is now under regulators. They put some restrictions. Amazon falls down to 2,000. Again, this is a probability based on the previous, how Amazon has moved previously, how Amazon options are being priced by institutional investors. It's not a guarantee. So I would never do this. Even though it shows me 100% probability of profit or 97% probability of profit. This is too big a position for a $50,000 account. That's where there are cases. And there are examples of these also, wherein people have sold way out of money options like this with 90% probability of profit. But that 10% scenario when it happened, it blew them away. So that is why I don't go to 80, 90%. Because the reward, in this case, the reward is what, $4. If the risk, if it happens, is too big for this pittance amount of reward, risk and the reward doesn't make sense. Around 70% probability of profit, that's where it starts to make sense. That is why I do around 70. Because again, this is probability, 1 in a million chance. What if it is March 23rd happen after I put this trade? Who knows? That is why. Will I not trade in Amazon? No, I will trade it. But then there are other strategies which we will see in the next session on how do I reduce the risk on Amazon and still trade in Amazon with a $50,000 account. We'll actually do some trades on these big ticker items in our next sessions. Hope that answers the question. Let's look at the next. Move on. Any other question before I move on? Okay, the second one is portfolio fit. See, now you figure out, okay, I want to trade it in Apple. I don't have too many positions on Apple already. So even if Apple goes down by 50%, I'll still be okay. And my maximum risk in Apple is 10% of my portfolio. If it goes down to zero, okay, I'll lose 10%, still survive in the game. Yeah. Fine. Check mark. Position size, check done. Let's move next. Portfolio fit. And this also applies to stocks equally as it applies to options. Asset diversification. Apple is good. What else I have in my portfolio? Check what else do you have? If other stocks that I have in portfolio are Facebook, Google, Amazon, DocuSign, Pinterest, Snowflake, Qualys, everything else, if I have too much of a tech exposure already, I don't want to do Amazon trade. Even though I don't want to do Apple trade. Even though I don't have any Apple positions, it is not helping from an asset diversification perspective. And this is one area where I've seen, especially the folks in Bay Area, especially the folks in my industry, which is tech industry. We all know a lot of tech companies. We live and breathe tech companies. Even though we try to diversify by not putting all eggs in one company, we end up picking the other companies which are in the similar sector, which is the tech sector. And if, like what happened today, the whole tech sector got spooked by just a news from Janet Yellen. Not even a news. She made a comment which she backtracked after the market closed. Whole tech sector was spooked up. Imagine if you have only tech companies in your portfolio. You would want to see your portfolio today. So look at it. Do you already have enough of it? Then ignore it. You don't want to overexpose yourself to one particular sector. Keep it diversified. Imagine plight of a stock investor who was mostly in airlines in February 2020. Would have been wiped off in March 23rd. Don't overexpose yourself to a particular sector. Maybe you work in a tech sector, you understand the technology, but again, markets sometimes don't just behave based on rational factors. So I always say many times markets are irrational, but markets are always right. They may be irrational, doesn't make sense, but the fact is market is always right. So it's of no use to us to come and say, oh, market killed me. Market is always right. We got killed because our portfolio was not geared to work in every type of a market position. So don't get overexposed to a particular sector. So if you already have too many trades in FB, Facebook or Google or Amazon, you don't need another Apple trade. Liquidity. The stock should be very liquid, especially if you are dealing with options. Make sure when you're looking at a particular ticker, it's not that you and some of your friends only are dealing in it. There should be a lot of participants that are interested in dealing in that particular stock. So if you have some sort of a scanner or some sort of a filter, go ahead and put it at least $500,000 or 500,000 stock transaction, stock volume. When you're looking at an options, stock is fine. Most of the cases, if the stock has got enough liquidity, options will also be liquid, but it doesn't harm to check at option volume also or open interest. Generally, I look at if in the first month, front month, the option should have at least 100 open interest. Let's say, let's pick up Amazon. So let me just bring up the open interest volume, right? So let's look at Facebook. I'm interested in 18th June because that's our next month. I mean, the next monthly is May, but May is too close. It's only 17 days away. Not interested. This one, it's got a decent amount of volume here and good liquidity and open interest also. Yeah, I'll be willing to do this. This is a very liquid stock. Trading options in, say, Google. Yeah, 478, decent enough. Trading options in Amazon. It's at close to near or at the money. Not that great, but not too bad also. Compare that with the, which one someone had pointed out to me, why you do not trade this particular ETF. I think it was, no, it was Hack and there was something else. Hack I traded in, it's okay, something similar to Hack. I can't recall now. So look at your open interest or volume. There should be some decent amount. 100 is a very decent number. But again, more important is this one. This takes, sometimes it takes time to build because if it is 90 days away, anyone, there may not be any trades on this one. But as it gets closer, you'll see more trades coming in. Because this will help us in the big ask spread that should be tight. And these two are kind of a tied to each other. If the stock is very liquid, more and more participants are willing to deal in this particular stock, then the bid ask spread will automatically be tight. Now, bid ask spread also depends on the value of the stock. So if it is, we are looking at Facebook, which is $318 stock, the difference between bid ask is about 40 cents. For $318, 40 cents is fine, but it is not fine if you're looking at Bank of America, which is $41 stock. Huge volume, 53 million volume. Huge options, 1,000 volume, 3,000 open interest. Bid ask spread, very tight. Difference is just a penny. I'll always be willing to trade Bank of America, provided it meet my other criteria. Very liquid. One of the good candidates to trade. Look at Apple. $137 million stock volume. Let's look at options, close to at the money options. And we are talking about June, not the closest one. Still enough volume. Bid ask spread for $127 stock is 10 cents. It's okay. Amazon, the bid ask spread will be wider because it's a big ticker stock. Not everyone can always deal in this. So it's got a $3 for a $3,000 stock. So look at what's the liquidity. Once you've identified that this, you don't have any positions, well within your position size guidelines, it's good for your overall portfolio from exposure perspective and see whether it's liquid or not. Because if it is not liquid, if the difference between bid and ask is too wide, then your ticket charge to get into this trade will be is the difference. So for example, you're trying to get into Amazon. It checks all the boxes, right? When you're selling it, you sell it at 118 and then you buy it back, you change your mind immediately. You buy it at 121. So you lost $3. That's a ticket charge. I know exactly it won't be 118. You will try to negotiate and try to sell it at a mid price, but you may not be able to sell it at a mid price. But if you want to sell it 118, you will be able to sell it. And if you want changed your mind because you realize, oh, too big for my position size, want to buy it, you'll have to buy it 121. That's the difference, is the ticket charge. We don't want to pay too big a ticket charge. So for a $3,000 stock, yeah, $3 is fine. For $100 stock, definitely not. So when you're dealing in options, look at liquidity. This is, if everything else checks out in terms of your diversification and the overall risk, this is the most important one, which is the liquidity. And again, I haven't yet talked about strike price, expiration. Those are not even in picture just yet from a priority perspective. And that is why I have a difficulty in giving an answer when someone asks me what strike price you picked up and what expiration picked up. Right? You have to go through these things first. Again, if it's more liquid, and as you move ahead in your option trading journey, you will realize it will give you more flexibility to manage the trades. Again, I do trades at 70% probability of profit. It means right from the day one, I know 30% of the trades will go against me. And in options, there's something called sequence risk. 70% doesn't mean that if I do 100 trades, 70 will be profitable. Or out of 200, 140 will be profitable. But maybe out of a 10,000 trades, 7,000 will be profitable. As you do more and more trades, that's where the probability numbers start to work out. Take a case of flipping a coin. 50-50 chance. Does that mean if you flip a coin 4 times, you will get 2 heads and 2 tails? No. Does that mean if you flip it 50 times, you'll get 25-25? Hell no. If I do it 100 times, will it be 50-50? No. It could still be 70-30. So would I like to, bet my house on that? No, I would not. I have to do enough trades. I have to flip the coin enough times. The more you flip the coin, the closer it gets to 50-50. So I know for sure that 70% is my probability of profit, but maybe given where the market is, maybe only 50% will be just profitable. Others I'll have to manage it. So if I were to manage those, that's liquidity play a big role in managing those trades. As you will see in later cases on trade management, and that you will realize that I want to add another trade, I want to roll it out. There should be someone to take the other side. I should be able to easily roll it out. I should be able to easily add another trade on top of it. So that's where the liquidity is important. And we should look at not only from the current trade, but also in the future if we have to manage it. Some examples: very liquid tickers: Facebook, Apple, Bank of America, Tesla. SPY, QQQ, many of these ETFs are pretty liquid, have very tight bid and ask spread. So if we want a list of some of the shares that I focus on when I'm trying to look for an option trades, I have a list of ETFs which I look through because I know these are generally very liquid, have decent interest in the markets, and I have my own watch list. So if you want that list, just shoot me an email at vivek@optiongig.com. Just ask for that ETF list. I'll share that. Once again, the email is vivek@optiongig.com if you want to get the ETF list. All right, before we move on to the next, let me look at questions. Okay, there's one question. In buying calls, if we check for bid ask price, the break even will change. Yes, whether it is buying or whether it is selling. Even for buying, if you were to buy it at playing in Amazon, you bought it 121, changed your mind, you have to sell it back at 118. Immediately, you lost $3. I generally focus on selling calls. So if you have a question which is specific, not selling calls, selling options, if you have a question specific to buying, ask it. I generally don't buy it. So most of my examples will be coming from selling. I've seen buying doesn't work in long term. So I want to focus something which I want to do for next 20, 30 years. Not for next 1 year or not for 2020, 2022. I want to learn and build a system, my own system, which works for me in a longer term. Next one, and this is specific to options. This does not apply to stocks. There's a concept called implied volatility in options. I mean, implied volatility as a stock, but we generally don't use it as a criteria if you're only buying or selling a stock. But this is a criteria, very important criteria if you're trying to deal in options. And this is where most of the retail investors, they get stumped because they had no idea of implied volatility. You're buying a call irrespective of whatever the IV is. And this is where the professionals, they take an edge against the retail traders. So again, we'll get into the details when we'll talk about option pricing. In that case, you will understand why this IV, implied volatility, is important. The couple of economists, they got a Nobel Prize for defining how the option pricing works. So don't expect me to explain every detail of that. Yeah. There's a huge math that goes behind pricing of options. But one factor that goes in pricing of options is implied volatility. So if you want to be active and use options in your portfolio, you have to understand implied volatility. For now, rather, without going into the details of the Black-Scholes formula, just understand that higher the implied volatility of a stock, more is the premium amount. So let's go back to our Thinkorswim platform. So let's pick up Bank of America. We can find out what's the implied volatility of Bank of America, right? Say here, 30.13%. So tomorrow, if this implied volatility, let's look at a premium. So premium is for 45 days. This implied volatility around close to 30%. Premium for $40 strike prices, say $1.16. Tomorrow, the implied volatility, it goes to 35%, 40%. This premium will just blow up. Could be anywhere to $1.50, maybe to $2. I don't have that exact math. But higher the IV, more is the premium. That's the basic concept. So if I'm trying to sell an option, when I sell an option, I get a premium. So I want to sell it when it's a higher IV. That's where my edge lies, so that I can get more premium. Same strike price. Just if the IV changes, nothing else changes. This premium will change. And this is one area where the retail investors generally don't pay attention. So higher the IV, more the opportunity to make money in the trade. So I want to sell when Bank of America is generally higher than usual. Because the converse is true. If I've sold an option now, remember, to make money, I have to buy it back. So I sold an option now at a very low IV. I collected low premium, and then IV spike up tomorrow, or closer to, or let's say 10 days later, IV spikes up. That trade is gone against me. There are other factors also, but look, assuming everything else is constant, if IV spikes up, that is gone against me. So my intent will be to sell when the IV is generally higher than the normal. Because then I know, okay, I'm selling at a higher IV, I'm collecting more premium than where it normally is, than where it normally stays. So when it goes back to its normal state of IV, that will be beneficial for me. So then I look at an IV. Now, IV is specific to each stock. So we looked at Bank of America, right? So its IV is shown to be 30. Is 30 good, bad? How do you find out? Because if I look at another stock, Fubo, its IV is 116. So is Fubo better or Bank of America better for me if I want to trade option in this one? Oh, by the way, I didn't define what an implied volatility is, so my apologies. So implied volatility is the expected, and I'm not going to get into the exact definition, but try to generalize it so that it is easy to understand. Implied volatility is the expected movement of the stock over, let's say, next 30 days. So if it is, so for example, if there is an earnings coming up, then we generally know that after earnings, stock either go too high or could go too low. It makes wild movements near earnings. So you will notice that as stock is getting closer to its earning, its implied volatility will start to rise. If I'm a biotech company and FDA is going to take a decision on my medical device that I've built as a biotech company, the implied volatility will shoot up through the roof, because anything could happen after that. If FDA approves it, stock will go high. If FDA rejects it, stock will be down in the drain. So implied volatility could be used as a proxy to understand the magnitude of the movement that the market participants are expecting in the stock, not the direction. It won't tell you whether it will go up or down. If IV is higher, all I know is that it is expected to make bigger moves. It could be in either direction, either high or low. If implied volatility is lower, in that case, the stock is expected to stay within a range, a narrow range. If your IV is higher, that range becomes bigger. It could make higher magnitude movements. More is the movement, higher is the option premium. More is the expected movement or implied movement, higher is the option premium. Now I was saying that IV are specific to each stock. Fubo has got an IV of 116 because it is very volatile. Is those new streaming service which is in fashion, which this stock goes, if you really look at it, it makes wild movements anyway. Goes up 5%, goes down 5%, 5 to 10% movement is nothing for this stock. That's the reason why its implied volatility is so high. Bank of America, on the other hand, is not as wild as Fubo. And some cases, some utilities, this is an ETF. Utilities generally are very stable. They don't move that much. So utility implied volatility XLU, which is utility ETF, its implied volatility is what, 17. So each ticker or stock has its own implied volatility, normal implied volatility level. So if you're making a decision looking at a, say, Fubo, and Fubo is at, say, 60, and you're looking at Bank of America, which is at 30, you would think that, I should do trade in Fubo, higher implied volatility, assuming everything, all other parameters have checked out, the previous one. But that's not the case. Because generally Fubo is 116. So today, if it is at 60 or 80, it is less than the normal. So how do you determine when you're looking at a Fubo, is today the right time from an implied volatility perspective? Is the current level of IV, is 116 good enough for Fubo? Is Bank of America 30 good enough? That's where comes the concept of IV rank. Now, if you deal in some of these stocks, you will know as you progress that where this stock's general IV is. But this is a concept called IV rank, in which you compare the current IV with its historic, means where it has been for past 1 year. And you don't have to calculate. Thinkorswim gives it to you. Tastyworks gives it to you. I don't know about other platforms. Shame on them if they don't give it. But Thinkorswim gives it to you right over here. Let's look at a Fubo. Going back, it's not been there for a year, so we won't have it. We'll need 1 year data. Any other more volatile stock which is there for more than a year? Let's search GSX. Yeah. So implied volatility is 121. Even though it calls it IV percentile in Thinkorswim, this actually is IV rank. A percentile is a different. I'm not going to talk about that today. I looked into the formula behind this. This is actually IV rank. 37%. So if I were to do a trade in GSX, 63% of the time, its IV has been higher than where it is today. It may be still okay to do this trade, but now I know the 121 is not that great. 63% of the times, its IV has been higher than 121. So IV rank compares the current IV with 1 year historical IV. Higher IV rank means today is a better day as compared to where the IV has been for last 1 year. Higher than 50, ideal. Today's scenario, even 30 is fine. It is because in 2020, because of COVID, IV was way higher than normal. So even with the 30, I think this 37% is good enough. Let's look at a Bank of America. Even though its implied volatility is 30%, its IV rank is 10%. So now suddenly things have changed. Bank of America doesn't look that attractive. Let's look at XLU. For a change, XLU, which is utilities, generally don't move. Implied volatility is 16. Bank of America was 30. But IV percentile is 30. So for utility XLU, if you want to do a trade, this is a good time to do a trade on XLU. So let me see, there is a someone has raised a hand. So if you have any questions on implied volatility, please ask. Oh, Alec, did you have a question? You're good. Oh, I see. What is HV in TOS? HV is called historical volatility. It says HV percentile. Percentile is a different one. So I don't use that. Look at your IV percentile. So I don't know how do they calculate this. So generally, if I talk about HV, HV is a realized volatility or a historic volatility. I don't know about think or same. Do they exactly mean by that or not? I hope so, because they got an IV here. HV should be historic volatility or the realized volatility. Next comes the option strategy. Okay, Tesla and Amazon. Tesla is generally is a higher IV. That's why in Tesla, the premiums are rich because it's a higher IV, 63. Current IV percentile is 8, but generally its IV is 63%. It's not like utility 16%. Amazon, I don't think it's got a huge IV. Yeah, it is IV is 30%, 29.84. But Tesla is generally, we don't know what Musk might tweet tomorrow and Tesla could move. So that's why its IV is generally high. Yeah. Next comes the option strategy. See, the strategy comes way later. You know, it's from a priority perspective too late than the others. I see one question. If current percentile is greater than implied volatility, then is that a right time to get in? No. So if the IV percentile, the way to read this is IV percentile greater than 50 means today the implied volatility is higher than 50% of the time if you compare as with the last year. If IV is 30, it means as compared to last year, it's been higher than 30% of the days. So which is okay. If it is like 20, then it means 80% of the days in last 1 year, the IV has been higher than today. So it means there is a 80% chance that if I buy or if I sell this option, it actually could go higher. That's the way to read it. So you don't compare percentile and IV percentile in IV. You look at IV percentile, that tell you how the implied volatility is today as compared to last 1 year. Now we talk about option strategy. Now, if you're a bullish, there are multiple strategies available. And each one have its own pros and cons. You can do cash secured put. We haven't talked about spreads, so I'm not going into detail of this. Naked put or cash secured put, same thing. If you margin, then it kind of become naked put. You don't have to put in the whole cash amount for that. If you are in non-marginable account, like say IRA, yes, you can do options in IRA. Then it becomes a cash secured put. So if you're bullish, you have these available. Again, option seller. Option buyer, you'll buy a call. I don't suggest doing that. If you're a bearish, again, you have options to sell a call or sell a call spread. But options give you a lot of options. This is not one way to express your sentiment. There are multiple ways. And what if I don't have any opinion? You can still make money without having any directional bias. And this is something which stumps the new option traders. Is like, can we make money without any thought of whether stock would go up or low? As long as I just know that the stock will stay in this range. I have an opinion that stock probably will not move more than say 15% or will not fall more than 15% in next 30 days. I don't know which direction it will go. So I could still create a trade which will be neutral from a directional perspective. There are iron condor, strangle, straddle, iron fly. There are many trades. Then you pick up what's your outlook towards the underlying. I mean, today I've done 3-4 trades, all neutral. Because I don't know where the stock would go. One thing I know today is volatility was high. Because after what was happening in the market, we saw volatility generally was high because the VIX was high. VIX went up 6%, 7% today. VIX is an indicator of fear or volatility of S&P. So VIX was high. So I was like, today is a good time to start building our June portfolio. I put that in a chat saying stars have aligned. Maybe it wasn't a good time if you're just a stockholder, but I was like happy. Oh, I was thinking to start building a portfolio with June expiration. Lo and behold, 45 days to expiration, which is my sweet spot. And implied volatility today spiked up. Means I can get more premium. So today was a busier day. We did a few trades today. So, or if you're slightly bullish or slightly bearish, you don't have to be a 100% bullish. You could still say, I am generally bullish, but maybe it could go to 5% lower. You can create option strategies using those. There are using options, you can express whatever type of sentiment you have. So that's where now you look at, if you're bullish, which one you want to do. Or if you're neutral, you have a few options. Which one you want to pick up. Make sure, if you're a bullish, make sure that this trade also helps your overall portfolio. And this last stuff I had to add it after a few years. Because say, I am bullish on Apple. I don't know, I keep going back on Apple. You really ask me, not too bullish on Apple, but for an example, So I'm bullish on Apple. I want to do a bullish trade. Everything else I've checked out. I don't have too many positions on Apple. Apple's IV is higher because the market generally had a higher volatility. The volatility across all the stocks went higher. So good time. And I'm bullish on it. But when I look at my portfolio, and we'll talk a little more about it in advanced section. But it's important to understand, so I'll just refer it to it. When I'm looking at my portfolio, I'm like, ooh, it's already very bullish. Do I want to add another bullish trade? Bullish means if the market goes down, it goes against me. In that case, even though everything else is checked out, I might restrain myself from, maybe I don't want to do Apple because my portfolio is already too bullish. In that case, I will search for another ticker on which actually I'm bearish. It could be maybe Facebook. Facebook went up too high too soon. I don't have any positions in Facebook. Its IV is high because the market IV is high. And I have a bearish thesis on Facebook. In that case, I will pick up Facebook over Apple. Because my rest of the portfolio is already bullish. Now, Facebook helps me if the market goes down. Facebook will benefit. My thesis is that Facebook will go down. So I want to pick up Facebook in that case. It helps the overall portfolio. And we'll talk more about it when we talk about hedging, is to how to start looking at from an individual ticker perspective. Think about from overall portfolio direction, portfolio perspective. At the end of the day, that's, I think, your goal is to increase the value of portfolio. You really don't care whether that is coming from Apple or Facebook. No, I don't know. Let me put it this way. I don't know about you, but I'm not married to Apple or a Facebook. I just want to make sure my portfolio grows. So look at the overall portfolio and then think that is this direction helping your overall portfolio or not. All right, next is then I'll think, okay, now I am Apple. I want to do bullish. What's the days to expiration I want to pick up? Because unlike stock, where we don't have to deal with days to expiration, options, I got so many options. What am I supposed to do? Which one should I pick up? Weeklies? Should I pick up 21st May? Instead of Apple, let me pick up something whose earnings are coming up. Docu earnings are coming up. Too far away. Docu just did that. Who else? Magnite. Yeah, there's Magnite earning is coming up on 10th. See, Magnite earning is coming up on 10th. So the closest option look at is implied volatility, 111. Because we don't know where the stock generally makes big movements after earnings. That's why the implied volatility is higher. After that, it has gone down to 92. So now in case of Magnite, oh, there's a lot more premium in this one. So if I'm bullish on Magnite, maybe if I sell this, I'll get good amount of a premium. If I don't mind owning Magnite at 35. So if I'm trying to do earnings, which generally I don't do anymore, I used to do it when I was initially beginning because it's a 50-50 chance. I generally pick weeklies. Otherwise, mostly I'll stay in the regular monthlies. Regular monthlies means May, June, July, August, not these weeklies. There are other reasons weeklies has got a little less liquidity and all that stuff also. 95% of my trades are all regular monthly ones. And then the last one is the leaps, which are longer dated, 6 months, sorry, more than 9 months, etc. It could be 700 days out till 23. There's a special reason why I do leaps, which is could be a stock substitution. I hold a stock, very capital intensive. I'll sell the stock and maybe pick up a leap. We can do a separate session on leap. I think I do have a recording on that one. But that will determine what expiration period should I pick up. Is earnings coming up? Do I want to take advantage of high IV during earnings? Or just my regular option premium selling, which is what I do mostly, which is a monthlies. Then few would be a leap where I have to do a stock substitution, which is more than 9 months away. Now, why I want to do, depending on the reason, I'll pick up the expiration period. Then the strike price. See, the price comes so late, or the expirations are so late in the prior day. Should I pick up a at the money strike? So if I'm bullish on Apple, should I sell a put on 125? Because it'll give me $3.50 of a premium, which is almost more than 2% for 45 days. Or should I go out of money? Should I go and pick up 90, sell a put at 95? Very less premium. So that depends on if I want to acquire the stock and I'm okay at 125, I'm just using it as a replacement of my limit order, I'll probably do this. If I want to give myself more room for error, or for example, if today is not a good day because most of the stocks have fallen down. If sometimes if I look at that, if a stock has, or maybe let's look at this one. Stock has fallen down to 127. And I think it has fallen down too much. Market should recover and should go back up. Well, maybe I'll sell it at 125. Or if I want to give myself more room for error, then I'll go and sell, let's say 120 or 115. So that's how we pick up at the money or out of money. Now my sweet spot is if I want to sell a premium, I will sell it at close to 30% or 70% out of money. I'll pick up maybe 120. So that I have a 70% probability of profit, probability of out of money. I'm selling, so out of money means profitable for me, 70% probability of profit. That's my sweet spot. Yeah, which means which delta. So generally it's like 25 to 30 delta is what I'll sell. Other thing, and this you learn by experience, is I also want to check sometimes that the same strike price exists in the later month. So this was June. I want to see 115 there in July also. Yeah, good enough. The reason is, in some cases, I ended up into selling a strike price, which was not available for the month after that. And the stock went against me. I wanted to defend it, to roll it out. I was not able to roll out because there is no strike price over there. So I added this last line saying, checklist also gets improved, that you add more content into the checklist. So check that the same strike price exists in the back month. Because once you start to manage it, you'll realize there are some management techniques, which is like roll it out to the next expiration period. But if you don't even have that strike price in next expiration period, then you kind of are stuck. I had one trade on Riot. I had it for May. 60. Not May, it was the one which just went by. Was it Riot? Oh, I think it was Riot. So if you look at Riot, for May, you have multiple strike prices. So if I pick up 49.5 or 43.5, and now that is being challenged. I want to roll it out to June. I may not even have 43.5 for June. Then I'm stuck. So I would rather pick up something which is also existing in the later months. Okay. Last one. Sorry, we are 7 minutes over, but this is the last one. After you have picked up your strike price, then you look at overall buying power consumption. So this is applicable only if you have a margin enabled on your account, which generally if you're more than $25,000, your account size is more than $25,000, by default, you'll have a margin. So I want to check by this trade, how much buying power is being reduced. Now by buying power, I mean, so if I have a $50,000 account, because it's a margin account, if I sell a put in which at a stock at a strike price of 50, it may only consume, instead of 5,000, it might only consume 2,000 buying power. The brokerage firm knows that it's not going to go to zero. They don't have to protect everything, but it may go down 20, 30, 40, 60%. So brokerage firm may block only 2,000 for doing the trade. Even though my full risk, if the stock goes to zero, is 5,000. But my buying power will be reduced by only 2,000. So I still will have 48,000 of buying power available. So you do more trades, even though the overall, let's say, March 23rd comes, everything goes down, falls down by 30, 40%. The risk is much bigger, but the buying power is not generally reduced at the same level in margin account. So you always want to make sure that you don't consume more than 50% of your overall buying power. That will help you save from any of those margin calls. It might seem stupid because in a stock world, we always think it's foolish to keep cash. We should stay 100% invested always. So now I had to unlearn that concept when I'm trying to sell options is no, keep your buying power. What Archego Capital didn't have anything left on the side. Got margin calls, could honor, account liquidated. I generally don't consume more than 50% of my buying power. And that will help you in March 23rd situation where the market has gone down by 30%. You still haven't got margin call. This is for longevity. Because the fact is you don't know, I don't know when the next moment will come when the market will drop 20%. So even though you might be thinking, why I'm not using full power of my account? And this is where some of the traditional media will say, stay away from margin because you could blow up your account. I'm like, no, make use of margin, but make sure you keep an eye on your available buying power. Don't go ahead and use completely. If you keep an eye on this, margin is an amazing tool. But if you forget about this and go up and load up useful margin, then basically we become the headlines of those horror stories. So look at an overall buying power consumption. That will be the last one. If you don't have margin, it's only cash account, then this is not even applicable because your buying power will always be reduced 100%. Yeah. All right. Takeaways a quick order. Position size number 1. If you're not okay with this, no need to move forward. Portfolio fit number 2. Liquidity, implied volatility. Pick up the strategy based on your outlook, expiration date, option strikes, overall buying power consumption. Now let me look at some of the questions. If you want to drop off, feel free. Apologies, we ran 10 minutes over, but I think this was an important topic to cover. So I appreciate you all staying Over here, I'll look at some of the questions and address those. So if you have a questions, put it in the Q&A box and let's go through that. Otherwise, good night. I know some of you are from East Coast, so sorry for keeping you late. All right, let's look at the questions. How is probability of out of money calculated? Different systems do it a different way, but this is all is calculated based on the options pricing at each of our strike prices. So I don't have the formula on how they've calculated, but if you're looking at what's the probability of profit, prob OTM is a pretty decent measure. Looks at historically how that stock has moved, what's the market participants are expecting right now, and then it comes up with the probability number. Next one says also check for dividends and earning dates. Yes, because if earnings is coming up, it means stock could move. It is expected to move. It's implied to move. So you need to see to check if you want to put an option trade where the stock could move a lot. And sometimes I don't do an option trade because an earnings is coming up in between. Now I want to do a trade in which I want to do a neutral trade and thinking stock could move only 10%. But if its earnings is coming up, stock could move way more. So again, it depends on what I want to do. So if I want to acquire a stock, and then I know that if earnings is coming up, the implied volatility is higher. In that case, I might do it. But if I want to do a stock just from a premium harvesting, in that case, if earnings is coming up, I want to do it as defined risk because it could move way more than expected also. So yes, we keep on earnings in mind. Also, I means how does it determine the stock movement? That's based on the option pricing for each of the strike prices. Is margin value will be different from account to account? So there are types of margins, and most of the time when you say if you have a $25,000 account size or higher than that, you get what's called a regular Reg T margin. So which is across the brokerage firms, it's kind of the same, not big of a difference. Now, if you increase your account size and you've done options for some amount of a time, brokerages can also give you what's something called as a portfolio margin. And they'll also administer a test to you. You have to pass that test, and then you can get a portfolio margin in which the leverage is a little higher. But then brokerage understands that you know what you're doing. You understand these concepts. You understand how to manage risk, and hence they are able to give that little higher margin. But that's a portfolio margin. Okay. In IRA, brokerage firms may not give any margin. So if it is in a retirement account, then generally no margin. Normal, your taxable non-retirement brokerage, you have a regular margin and you have a portfolio margin. Okay, so a question from Fidelity or Ameritrade. My request of call put goes to OCC and then they assign to us. So whenever you do a exercise, I'm hoping you're asking about that you bought a call or a put. Whenever you want to exercise it, now I don't know how exactly Fidelity manages it, but generally when you exercise it, it goes to OCC and OCC will assign you to any of the partners. Now, is Fidelity doing something wherein they'll actually assign you to within their own brokerage house without sending to OCC? Maybe. But OCC is a kind of a guarantor. that say if Fidelity become rogue, then OCC will make sure that they'll find the stock for you if you want to exercise your call option. Ramesh, is margin requirement based on portfolio valuation or broker dependent? I think I already addressed it. So portfolio margin is dependent on the value plus how much is your understanding of the option stuff. So they actually give you a test. Regular margin is if you add $25,000 plus, the broker will give regular margin. And I think Fidelity, Tastyworks, TD Ameritrade, they all do it. That's pretty standard. Last one, does it go to Citadel first and they send it to 13 exchanges? That what you're talking about is when you're trying to buy and sell options. So we haven't talked about how and that is applicable not just for options, but even stocks. In terms of when you buy a stock or when you sell a stock, you buy option, sell an option. Whom are you dealing with? In some cases, it goes to market makers, which is Citadel. It could directly go to exchange. But today's world, because you can get better pricing through these market makers, through these high frequency trading firms, most of these orders actually first go to high frequency trading. They fill it up as a better price than exchange. And you don't directly deal with the exchange. So before I became active in market, I read the book Flash Boys, and I hated high frequency firms. Before I became, dealing with the options. After dealing with options, my outlook towards the high frequency term folks have actually changed. They are doing a good job for retail investors. They give me a better pricing than what exchange would give. So I don't care if they profit a little bit, as long as they can give me better pricing than what exchange can give. So why do I envy if they make some money? It's like exchange is giving me at $100. High frequency trading firm can give me a 99.995. And if they make a penny out of it, how do I care? But you can select the exchange. Yeah, if you want to, in TD Ameritrade, you can. In Thinkorswim, you can. But I don't think in all the platforms you can select the exchange away. Thinkorswim allows you to select an exchange if you want to route it directly to an exchange. Yes. Otherwise, Thinkorswim will route it to whatever the those are market makers they work with. Citadel is one, Susquehanna, Jump, Securities. There are many market makers. So depending on which market maker work with what broker, they'll route it. And that was a big deal. This whole Robinhood, everyone was saying, oh, market makers are bad. These HFTs are ripping off retail investors. I don't think so. That's a good narrative that gets people attention. But if you take out HFTs and send orders directly to exchange, each one of us will have to pay higher amount than what we are paying today. And I didn't know it until I actually became active and started trading options. When I read Flash Boys, I'm like, we should get, rid of these high frequency traders. Not anymore. My put option did not fill up today, even though my premium was less than was my friend. Yeah, because Robinhood, so it depends again what market maker. So the issue with Robinhood is you don't pay anything upfront, but we get backstabbed by bad fills. So I think very beginning of one of the bootcamps, someone asked me, why don't you trade on Robinhood? They have $0. They have zero commissions for options. On TD Ameritrade, I pay commissions. My response was, in order to save 45 cents on commissions, I don't want to get a bad fill, which will cost me $5, which is not upfront. So users don't realize because it doesn't show up, but you get a bad fill. I can get a cheaper. I can, when I sell an option, I can get more premium if I'm on TD Ameritrade. And that 5 cents premium means $5. On Robinhood, I may not be able to get that. I'll have to be happy with 5 cents less. But when you're on Robinhood, I actually opened an account in Robinhood because I got questions. I'm like, okay, if I were to answer anything, I need to use that. So I have a Robinhood account. But when I'm on a Robinhood account, I would not know how is it as compared to the other brokers. Yeah, so Robinhood not good for options. It's a good interface, but doesn't make good money. You have to pay higher cost. If current percentile is higher, then we can choose to sell option. Yes. So today, if we look at, if it is 30, 40, it's a decent enough to sell a premium. Cool. All right, so let's call it a night right here. If you have more questions, maybe let's talk about it in a Saturday meeting.